Let's take a look at your market news now. Asian market trading floors are nervous. This ahead of President Donald Trump's announcement of specific import tariffs on Chinese technology goods expected later today. He's accused the country of breaching U.S. intellectual property rights. Tokyo stocks registered positive gains today. This as bargain hunting after 3 straight days of losses offset a stronger yen. The benchmark Nikkei share average closed up 1%. Yesterday, the country's exchanges were closed due to a national holiday. In Hong Kong, following the U.S. Fed interest rate hike, the Hong Kong Monetary Authority also adjusted its interest rates up by 25 basis points. The country's currency is pegged against the dollar and so therefore has to generally adopt similar monetary policy to the United States. The Hang Seng Index closed down 0.4%. China stocks also declined, led by consumer and real estate firms, as investors digested the impact of a rate hike by the U.S. Federal Reserve. While serious concerns about the prospect of a trade war remain, the Shanghai Composite Index ended 0.5% in the red. U.S. stocks ended a tad lower last night. While stocks had started well, gains were given up following the Fed's decision to raise rates by 25 basis points, while also indicating that it only expected to levy a further 2 rate hikes this year. The market was open to the possibility of a further 3. Now, a less hawkish tone from the Fed saw the US dollar weaken. The Dow Jones Industrial Average fell by 0.2%. The S&P 500 declined by the same margin, and the Nasdaq Composite Index slid by 0.26%. Let's take a closer look at the markets. Nompumelelo Siziba is at the Johannesburg Stock Exchange. Good afternoon, Nompumelelo. Over to you.
Thanks very much, Nzinga. Well, global markets are generally in the red and the all-share index is no exception. We see that industrials in particular are taking strain, down by nearly 2%. And I suppose that might have something to do with this anticipated announcement from President Donald Trump around what import tariffs he's going to levy onto China. The quantum is said to be something in the order of about $60 billion. It's not thought to be so consequential for the Chinese economy, but of course there's a concern about the ripple effect that this policy will have. Will there be retaliation, and will the US then levy even further import tariffs on other sectors like apparel and so on and so forth? So that's the situation at the moment. In terms of the local currency, we see that its trend is slightly weaker, and that's despite the US dollar weakening relative to its currency peers. Of course, locally here, markets really looking forward to seeing what Moody's says about our prospects and our credit rating specifically. Let's take a look at the indicators. Now I'm joined by Herbrand Smit. He's from NEFG. Thanks for joining us, sir.
My pleasure.
Good stuff. Global markets generally seem to be in the red. For some reason, they don't seem to be very happy about the Fed Reserve's decision to up rates and actually not forecast more rate increases for the rest of the year. What's going on?
Yeah, look, I think they've actually hinted towards one more over the next 2 years than what previously were priced into the markets. And I think that's what they're hinting towards. Interest rates rises are normally not good for markets. And they always say, there's a saying of the bull market don't die on its own. It normally gets clobbered by the Fed. So let's see and see how the reaction goes long-term wise. They have been gradually over the last few years, and you would have expected some more bullish and more hefty increases over the last 2 years, but they've been slower than most people expected. But still, it's very low long-term wise, and if it needs to normalize, you're probably going to see some ripple effects in markets.
And then I mentioned in the introduction this anticipation of Donald Trump levying specific taxes and import tariffs, on China around the technology and telecom space. How worried are you about this?
Yeah, look, I think those are, I'm a believer, first of all, in the free market, so you would have hoped that there's none of those globally, but yeah, there is some governments that protect some of their local industries with some tariffs, etc. I don't think that's a big deal. It's 60 billion US sounds a lot, but I think in the US-China relationship, it's probably not a big deal with trade going both ways, much larger sums on that front, but I would be wary of him actually going on big-scale trade wars. They must also just remember that the Chinese actually owns a lot of their debt, and they can actually have negative consequences if they pull their money from the US.
Indeed, because they won't be able to have enough money to pay off their operations, will they?
Certainly, and you're going to see hikes, spikes in the yields, etc., if they pull their money.
And then just before we went on air, we noticed a piece of news about Naspers. Naspers has had a 33% stake or so in the Chinese technology company Tencent. It's now decided to sell a 2% stake, and it's going to get a whopping $10.6 billion. Just give us a sense of what you think about this, and what do you think they should be doing with the money?
Yeah, look, they say they're going to invest it in their online and classified businesses, which does bode well, so it won't consume more cash from other avenues, etc. But a lot of shareholders are probably scared over the last while and actually blaming Naspers for not the greatest asset allocators over time. But still, they made the correct decision to invest $32 million in 2001 in Tencent, and it's paid off heftily. 2% now is worth $10.6 billion, so serious growth on that front. It is a lot of money. The positive out of it is that it shows that they can actually sell the shares. There's a lot of people who are worried about how the structuring of the Tencent holding were within a V company in a few other jurisdictions, etc. So there was a lot of fear around that, and I think it shows that it is sellable, the shares, and that should have been a positive. But on the other front, it looks like there's more negative people on the asset allocation front, and the shares actually down by almost 9% this afternoon.
When you're doing your due diligence, looking at stocks out there that could accrue the kind of returns that Tencent is giving to Naspers, for example, where are you looking to invest, especially given that things are looking sunnier for South Africa?
Yeah, look, it's the SA Inc. that has been more rosy over the last 3-4 months. We have been invested in there for about 6-7 months, some of them more than a year already. So there's a lot of shares on the local front that looks cheapish. It was a bit ex-growth over the recent few years, but of course, if we see interest rate cuts going forward, the consumer will probably pick up on the local front, and you'll see good times. Banks are some of them. We've been invested in them for quite some time. They've actually re-rated quite nicely, about 30% over December alone, so the bit of a Ramaphosa rally effect that we had there. And then, of course, there's a few neglected ones still out there, the Roynets of the world, the MTNs of the world, the AECI on the chemical front, etc. So I think we got quality companies. They've been neglected over the last 5 years because everybody was piling into Naspers and British American Tobacco. And what we have today is we have British American Tobacco down by 4% and Naspers down by 8%, and some of these SA Inc. names actually going up by 2%. So we're very happy investors at the moment.
The big deal for us here in South Africa is Moody's decision on our credit rating. Many analysts believing that, in fact, we're going to avoid a ratings downgrade. But even if we do, I mean, there's a heck of a lot of work that needs to be done, isn't it, for us to avoid them this year?
Yeah, I think so. There's a lot of positive sentiment from December onwards until now. So we also, some of the believers that think we're going to avoid the downgrade as of tomorrow. And they'll probably give us the benefit of the doubt, but yes, there is a lot of work still to be done. We just had the SARS Commissioner Tomuyane being suspended. There's a lot of other people, I think, that needs to go as well, and you need to see some action from that front. You need to get credibility back in all the SOEs, and you need to get state finances back on the right track. You certainly can't tax South Africa more as you have over the last 4 to 5 years, and money going to corruption. It was just not done.
In 30 seconds, do you think the Reserve Bank is going to cut interest rates next week?
I think so, and by 0.25.
And why so?
Interest rates, inflation are certainly not to worry about. We saw the latest numbers at 4%, and that should be their target, combined with growth. And I think they left that statement out for the last year. So they were afraid of a lot of Fed interest rate hikes and a lot of political uncertainty, and also downgrades. Those are gone. Inflation are very low, so they certainly have scope to actually cut twice this year.
Well, let's hope they do. Thank you very much for your time. Herbrand Smith there, thinking that we'll get in some luck and get the Reserve Bank to cut interest rates. That's despite the US Fed deciding to raise rates and promising to continue raising rates for the rest of the year.